Alrighty, good morning everybody. We'll go ahead and get started here. I want to welcome you all to today's webinar. My name is Thomas Wood. I'm the Director of Trading Operations at Microquant and also the host of the Value Charts Futures live trading room. Today we're going to do just basically a brief intro into consistent profits for weekly income. I'm going to talk about a really good trade setup that we use on a daily basis, and I'll show you some markets with some examples of that setup working. I will also cover just a little bit about some money management that is very important, some principles that are very important in order to earn weekly consistent profitability. So before we really dive right in, just a quick risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41, which is just a hypothetical disclaimer. It's basically saying that obviously if we're showing you previous charts where things worked in the past, we can easily say, hey, look, it worked great here. No guarantee it's going to happen in the future, although we do trade these daily ourselves, these setups, so we do believe they work. Now, first things first, money management. This is one of the most important parts of trading, especially if you're trying to trade a smaller account, trying to go for consistent profitability. Money management and risk management are two of the most important aspects of trading that many people just skim right over. They go straight for, let's find these great setups, let's find these great ways to trade, the best indicators out there, but then they don't learn the basics, such as making sure you have reward risk ratios that are good. So let's go ahead and talk a little bit about some money management principles, just some basic ones, and how they help you. So general rules for money management. Rule number one, make sure you know the trade when you place it. So where's your stop going? Where's your profit target? Why are you placing the trade? So when you're trading, you should have a reason for getting in, whether that be I'm getting short because there's a bearish divergence or I'm going long due to a bull flag. You should have a setup and you should have a valid reason for getting into a trade. Before you get in, you should know what that reason is, and you should know where your stop is going. You should know where your profit targets are. You should know basically the game plan. This is one of the reasons that a trading plan, we always talk about those here at Value Charts. Trading plans are very, very useful because that gives you the set of instructions on what you're going to do, how you're going to manage the trade, why you're going to manage the trade the way you do. As long as you have those rules, you should be able to do rule number one very easily. You should know the trade when you place it, whether you're going for a swing trade, day trade, etc. Rule number two, you don't want to be rushing your trades. You want to let them come to you as a trader. One of the biggest mistakes I see people make is they'll come in every day and they go looking for that setup. All right, I'm going to go look for a way to trade this market today. When you're actively seeking, when you're sitting there trying to go through the markets and find that setup instead of just letting it come to you, you're going to have a lot of forced trades. So you're going to have trades that don't work out quite as well because you've convinced yourself that it's a valid reason to get long or short. So it's very important to wait for those gems, wait for that really good setup. If you are patient and if you are waiting for the good setup and you're only trading those good setups, the probability of you being successful, the probability of you having a profitable trade and of being able to consistently bring in profits is much higher. So make sure that when you're trading, make sure you're not rushing in to take a trade. Let it come. You'll know when it happens. You'll see the good setup. You'll say, hey, look, that's textbook. That's right what I was looking for. All I had to do was wait for it. Then you jump on that one. That's the one that's going to be the one that works out for you. Rule number three, Don't feel bad about missing a trade. Another thing that I see happen is a lot of new traders will come in and they'll miss a setup. So the market has gone against them, and then they'll try to chase it. So they'll see a market, there was a setup there, they didn't take it, and then the market moves, and they go, oh no, it's moved. I can't believe I just missed out on making that $1,000 trade. That was such a good setup. That was such a good opportunity. I don't know what I was thinking. They'll sit there and beat themselves up and beat themselves up and beat themselves up. Well, emotions in trading are one of the biggest things that hurt and it's detrimental to a person's trading account. So if you're sitting there beating yourself up because you missed a trade, you're more likely to try to force a trade, go back to number two. You're more likely to do number two if you are upset about missing a trade. So don't be upset about missing any trading opportunities. There's always going to be another trade opportunity in the future. The markets, there's always going to be a better one. There's always going to be a bigger move. Nothing is... You shouldn't be upset about missing an opportunity is all I'm saying. I'll just let it go. Say, okay, I missed it. I won't miss it next time, and then keep on going. Don't try to make up for it. Don't try to chase it. That's another thing that a lot of people will do is, let's say we had a short signal here based off of bearish divergence. So we had a sell all the way up here. Well, the market's already moved all the way down here, and people are going, oh, I missed it. Can I get in now? Well, you just missed 3/4 of the trade. This market may go down to here, but remember, the further a market goes down or the further a market goes up, the least likely it is to continue. Okay? So it's kind of like if you think about a rubber band, the further you stretch a rubber band, the more likely it is, the harder it becomes for it to continue to stretch. The more likely it is for it to come back together and snap back together or just break. So yeah, sometimes you do get those 3-4 standard deviation days where a market just goes through the roof, but more often than not, the further a market goes up or the further a market goes down, the higher the probability of that market actually pulling back and reversing or consolidating. So if you're trying to chase it, the higher the probability of you having a losing trade or getting at the very top or the very bottom is. And this is one of the reasons that value charts are so useful for this, is because as long as you're going long from undervalued and going short from overvalued, you know you're normally on the right side of the market, so that rubber band's been stretched so far one direction is more likely to pull back the opposite. Another thing, and this is very important for consistent profitability, know when to be happy with a good day. I've seen traders, they've gone out, they've made $10,000–$15,000 in a day, and then they've gone and given it all back and ended up with a down day because they thought they could make more or they wanted to make more. Look, if you're trading, this is especially for those of you trading smaller accounts, in my opinion, if you're up $2,000–$3,000 in a day, if you have a $30,000 account, you're up 10% on a day. I used to work for a financial planning firm for private wealth management, and their goal for an entire year's return was 5 to 7.5%. If you're earning 10% in a day, be happy with it. Keep in mind the big picture. If you go in and you consistently can make $500 a day, if you're consistently making $500 a day, you're going to be making over $100,000 a year when it's all said and done. So keep in mind, know when to be happy. Know when to say it's a good day. You're up a couple $1,000s. Go ahead, take a break. Go do something else. Go eat dinner with your wife. Something like that. So make sure you know when you're happy or know when you're up. Make sure you keep the profits. Another thing that you want to, along those same lines with know when to be happy when you have a good day, is when you do have a really good day. So if you're up, this is for smaller accounts again, if you're up, let's say you have a $50,000 account, you're up $2,000 on a day, you should never let that go less than zero or less than 1,000 really. So don't ever have a good day turn to a bad day. Never give up all the gains that you've had. Don't get greedy. Another couple more good rules, just general rules for money management. Make sure you have a minimum reward risk ratio of 2 to 1. That means for every $100 you're risking, you need to be earning at a minimum, so that trade should make at least $200. Okay? The reason you do this, the reason you have to make sure you have a good reward-risk ratio is because the better your reward-risk ratio, the easier it is for you to be profitable. The easier it is for you to continue and consistently make profits. Because with a 2-to-1 reward-risk ratio, you can be wrong twice as much as you're right and still be at even. You can be wrong 10 times and be right 6 and still be profitable. Okay? So it allows you, gives you a little more leverage. It gives you a little more slack with your trading. So you don't have to be quite as perfect if you have a good reward-risk ratio on all your trades. This is another one of the big mistakes that new traders make is they'll come in and they'll start trading and they'll let all their losers, so they'll let all their losers go all the way to their stop loss. So losses will equal 100%. So they'll take 100% loss, but then they'll get out at only 50% of what that move was, or 10% of what that move was. So they'll be risking $200 on the trade, but they'll get out with $100 in profit. So their gains, they'll only take 20% of the total move out on their profitable trades. Now this is just a recipe for disaster, because this makes you have to be right so much more often than you are wrong. It makes it so much more harder on you as a trader to be consistently profitable. So make sure you're letting those winners run. Now, one of the easiest things to do for this, for people that want to know what their profit target should be, so you don't know when to get out. Well, very easy thing to do. You go, okay, I'm risking $100. I want to have a 2-to-1 reward-risk ratio. I'm exiting at plus 200 no matter what. Or you could even do a 3-to-1 reward-risk ratio or 4-to-1, just depending on the type of setup it is. So make sure you know where it is that you're getting out. Make sure your reward-risk ratio is a minimum 2-to-1, because the better your reward-risk ratio, the easier it is to be profitable. Another big mistake that people make in futures is they are over-leveraged to the max. Okay? Rule number 6, always trade smaller than you think you should. This is a lot of times you'll see people come in, they'll start trading futures, they'll have a $10,000 account, and then they'll go trade 2 contracts of gold at once. That way too much leverage. All right, leverage is a double-edged sword, and 90% of the time, most of the people I see that use too much leverage, instead of making more gains than they normally would, they lose a lot more than they normally would. Because you get scared, and what you do is they'll start, instead of having a stop loss where they should have been risking $200 per contract, they'll trade 2 contracts and then risk $200 for 2 contracts, which means it's half as far away as it should have been. So if this is where your stop should be, all the way up there, the market's here, well, you trade 2 contracts and you want to risk the same amount of money, so they'll go and they'll put their stop here, and the market will come back up right there, hit their stop, and then knock them out. That way you lose $200, where if you, instead of making any money, you lost 200, whereas if you would have traded 1 contract and put your stop where it belonged, you could have risked the same amount of money and you actually would have been profitable. Granted, it would have been half as much profits as if you had risked the correct amount with 2 contracts, but still, one of the biggest mistakes people make is over leveraging. Again, you're not going to become a millionaire overnight, but if you are consistently profitable and you're consistently taking out a couple hundred to 1,000 or so a day, that's going to make you earn $1 million in a very short period of time, because as your account size grows, then you increase your leverage. So think about it this way. If you start off trading market, let's say you have a $50,000 account, and you start trading 1 contract. All right? Someone that trades a $50,000 account, they're trading 1 contract. Let's say they take that account all the way up to $60,000. So they have $10,000 worth of gains. Well, now they decide they're going to go ahead and do 2 contracts. What you've done is you just doubled your risk, but you only earned a 20% increase in your account size. So your account increased by 20%, but your risk doubled. So one of the biggest mistakes along the same lines is people, they start jumping up their risk much too soon, much too quickly. Double your risk when you double your account. Stay trading smaller than you think you should. Again, people have goals of earning 5 to 10% a year, 5 to 7.5% a year. You can very easily do that trading one contract on a $50 or $60 or $70,000 account. You can even do that on a $100,000 account very easily. If you think about that, a $100,000 account to earn 7%, you only have to earn $7,000. Well, you can earn $1,000 a day trading one contract. So don't over leverage yourself is what I'm saying. Trade smaller than you think you should. Next rule. After getting stopped out, reevaluate the trade. Is it still valid? What you don't want to do is, let's say a market's coming down, you're trying to buy. So this market's coming down here. So you buy, you're out. And then you get right here and you buy again because you go, oh no, it's starting to go back up. I just missed it. Buy, and then you're out down here. And then you get back in, and then you're out. And then you get back in, and then you're out. Well, what you've done is instead of just having one contract and letting that go all the way down there, you've added, there's additional losses, there's additional losses, there's additional losses, there's additional losses because you're getting back in a worse price than you got out. If you do get stopped out, it doesn't mean you were wrong on the trade. Reevaluate the position. Is it still valid? If yes, then jump back in. Do not repeatedly jump back in over and over and over and over again and just chop yourself up all day long because you'll lose so much more money than you could gain. All right? So when you get out, evaluate it. If it's still good, try it again. I personally don't like trying to trade more than 2 to 3 times. All right? If I have to try it more than 2 to 3 times, and really the best trades are the ones that work out the first time, obviously, but if you have to try it more than 2 to 3 times, there's probably something wrong with your idea. It's okay to be wrong. Just step back, leave it alone. And then the last rule I'll talk about today for money management before we start talking about a couple strategies you can actually trade is limit your losses. Do not limit your gains. Okay? Some people will put a daily gain. They'll put a limit on how much they'll make a day. Okay, if I get up $500, I'm going to stop trading. Well, treat each trade independently. Okay, you could have one trade that's up $500. Well, that trade has the potential, if you had projected that market going down $2,000 worth of a move, why would you get out at plus 500? What you can do is just put a break-even stop in place plus a few ticks so you lock in a little bit of money and then try to let it run. If it really starts to move against you or you have a very valid reason to get out of it, then jump out of it. But don't cut yourself off, sell yourself short on trades that could be much better than what you actually have. All right. The other thing is limit your losses. So if you're trading throughout the day, don't ever have that blow up day. Don't ever have a day where you're making $500 a day consistently. Then you go in one day and you lose $2,000. Well, you just wiped out 4 days worth of trading. So limit the losses. Don't limit your gains. Allow your winners to run. All right. Any questions on some of these general rules for money management? Some pretty simple principles, but a lot of times these get overlooked by a lot of new traders. All right, let's go ahead and talk about a couple setups. What we call bull or bear flag, or if you're in the trading room, we call bear flags a lot of times golf clubs. So we'll talk about those. What percentage should be risked on any one trade? It depends. It depends on the account because you can't say a set percentage because if you have a $10,000 account, your stop still needs to be placed far enough away that you're risking more than 1 or 2%. But if you have a $100,000 account, it's a lot easier to risk 1 or 2%. So I would personally try to risk, even with a $100,000 account, I'd personally be trying to risk $200 to $300 a contract. By limit losses concept, I mean to use trailing stop loss, right? No. By limit losses concept, I mean if you're down X amount on a day, stop trading. Don't allow yourself to have that blow up day. All right, let's go ahead and start talking about some bull and bear flags, and then we'll do some more questions at the end. A bear flag pattern is a bearish continuation pattern. What it is, it's a down move followed by 1 to 4 higher lows with a move back into fair value or even into overvalued, and then a break of the previous bar's low followed by strong momentum. So it's going to look something like this. The market's going to come down, then you're going to come back up, and then you're going to go back down again. Okay? The reason I call it a golf club in the trading room is because I think it looks like a golf club. There's your handle, there's your club face. Okay? So it looks like a golf club down, followed by consolidation, followed by continuation down. A bull flag is the exact opposite of a bear flag. So take a bear flag or a golf club, turn it upside down, flip it on its head. A bull flag is a bullish continuation pattern, which is an up move followed by 1 to 4 lower highs with a move back into fair value or even into undervalued, and then a break of the previous high followed by strong surge momentum. So it's going to be an up move like this, followed by a pullback, followed by a continuation to the upside. Okay, basically the exact same thing, but flipped on its head. So, how do you trade a bear flag? You're going to enter on the break of the previous bar's low, and your stop is going to be above the previous bar's high. Now, these examples are all from daily price charts. So, that being said, I would never, or very, very, very rarely would I put my stop all the way up at the high. Okay? Especially on daily, because that's a lot of risk, especially in a market like gold. You drill down intraday and try to find a intraday chart that can give you less risk. All right, so looking at gold, here's an example of this bear flag or golf club. You have a down move followed by 1 higher low, 2 higher lows, 3 higher lows. So you're looking at the lowest low of the price bar. And if it's higher than the previous bar's low, you started the bear flag. So sometimes it'll only be 1 higher low, sometimes it'll be 2, 3, 4. Once you have those higher lows, you're looking for the break of the previous bar's low. So you see this bar with a big red arrow above it broke the previous bar's low, right where that red line is. So you go short as soon as it breaks the previous bar's low. Your stop would be above the high. Now you can use the same setup intraday, all right, and it'll have a lot less risk than end of day or using a daily chart. So the smaller the time frame you find these setups on, the less risk you're going to have because your stop goes above the high of the broken bar's low. So this is the bar, the broken bar's low. So your stop's going to go above that bar's high. You're going short on the break of the low. Your exit can be 1 or 2 times or 2 or more times reward risk ratio, or you can use a value target. So you get out at significantly undervalued, or you get out as soon as you put in a new higher low, or you break the previous bar's high. So first profit target would be 2 to 1 reward risk ratio, so you'd be out right there. Second profit target, significantly undervalued, right there. Third profit target, break of the previous bar's high, right there. Okay? Either way, all 3 of those, very valid exits, very valid trade. Oops. Now, one thing to watch for, when you have a bear flag or when you have a bull flag, you expect the market to retest the previous low at a minimum. So roughly 75 to 85% of the time, you're going to get a retest of this bar's low. Okay? So at a minimum, you're expecting it to get down to the previous low. Sometimes it'll just test that low and then bounce right back up. If you break that low, then you're in the clear to continue on down. Hold on, a lot of questions coming in. 1 second. What do I mean by 1 to 4? I mean 1 to 4 previous bars. So, or 1 to 4 higher lows. So this is your down move. This is higher low number 1, higher low number 2, higher low number 3. I would do it all the way up to 4 higher lows. So 1, 2, 3, 4. Then there's a break of the low. After that, you're probably looking at a reversal or looking at it potentially setting up a bearish divergence. When you have these flag setups and many make a correct entry, what percent of trades should we expect to be winners? This is probably one of the highest probability setups that we use. This is why I like it so much, is it works really, really well. You're probably looking, I mean, this is just a guesstimate, but probably 75–80% of the time it's going to work out. If you have one contract, where would your exit be? That's a very good question. When you're trading smaller accounts, it's a lot harder to have two contracts and take half profit and let the second half run, which is what I normally would want to do. If you're trading one contract, it makes it much more difficult. That's where that reward risk ratio comes in handy. So if you're trading one contract, make sure you at least have a 2-to-1 reward risk ratio. I would personally be looking at maybe getting a 3 or 4-to-1 reward risk ratio and then exiting. For day trading, what time frame is best to look for bull and bear flags on? Good question, Dan. They work really well on 30-minute charts. Chip, I wouldn't really, when I say drill down to a smaller intraday time frame, I'm going to talk about 1 or 5-minute charts. I wouldn't really want to go less than about a 15 or 30-minute chart. The reason being, you're expecting at a minimum a retest of the previous lows here. Well, on a 1-minute chart, the move from there to there could be $30 or $40 a contract. So not enough to really make it a good setup. I want to at least have a couple $100 a contract worth of potential on the setup. Where did you short in this example? You enter the sell on the break of the previous bar's low. So as soon as it breaks a low, you get short. You don't wait for a close down. You get short as soon as it breaks. The thing that you want to see happen is you want to see the bar that breaks the previous low, that bar needs to close down. So it needs to open and then close lower. You don't want to see it open here, break the low, then come all the way back up and close like that. More often than not, it's a false breakout and it's reversing. So you want to see it close down, but you're getting in as soon as it breaks the previous low. If you do not reach a 2-to-1 ratio, do you go to break even? Yeah. When I'll normally go to break even, if I've risked $100, if I've risked $100 on a trade, I'll put break even at plus 100. So when I'm up $100, I will go ahead and put a break even stop in place. That way, when you have a 1-to-1 reward risk ratio, you put a break even. Do futures have same-day trading restrictions as equities? No, they don't. All right, so let's go ahead. We got to move on because we only have an hour to cover this. I'll keep on sending questions. I'll answer them as we go. So here's an example of a bull flag. Okay, this is the S&P. Now, the S&P is one of the better markets for doing this. Watch for this to happen in the afternoon, after lunch, okay? The S&P does this. All the indices do this all the time. Before lunch, so after the market opens, until about 12 o'clock, you'll move one direction or the other. Then you'll start consolidating until about 2 o'clock, 1:30, 2 o'clock, and then you'll continue on in that direction. Or back here, you can see down move before lunch, consolidation over lunch, continuation after lunch. Here, up move before lunch, consolidation over lunch, up move after lunch. Okay, so this is a bull flag. Works really well on the indices. Works really well in RBOB and heating oil and crude oil as well over lunchtime. So here's an example of a bull flag. Big up move, followed by 1 lower high, 2 lower highs, 3 lower highs. You get in, so you enter the long on the break of the previous bar's high. Your stop goes below the low. Your first profit target is 2-to-1 reward risk ratio or significantly overvalued. So you have a lot of different options for getting out. You can use a value target. You can use 2-to-1 reward risk ratio, 3-to-1 reward risk ratio, etc. Either way, it worked out really well. The other thing you could have been looking at here, remember, you want to see it pull back into fair value or undervalued. So we go up overvalued, which are the upper yellow and upper red price bar segments. We came all the way back down undervalued, which is the lower yellow price bar segment. And then we continued on, followed by a surge in momentum. So you see our momentum surged up again. Okay, worked out really well. Back here, same sort of scenario. Down move before lunch, followed by higher low, higher low, higher low, fourth higher low, break of the low, continuation to the downside. Again, you're expecting at least a retest of the lows. Just like over here, you're expecting at least a retest of the highs. Does that make sense? So very, very simple setup. Works really well. Hold on, a lot of questions coming in. So let me try to answer some of these before we move on and look at some more examples of some bull and bear flags. So if it reverses on the entry bar, do you exit? Yes, if it reverses on the entry bar, so if the entry bar doesn't close up for a bull flag or down for a bear flag, so for example over here, if this bar right here didn't close up like that, or if this bar right here didn't close down like that, you'd be exiting. This, by the way, is also a bull flag. Up move followed by a lower high, a break of the high, and a run. Remember, you're expecting at least a retest of the highs. There's a retest of the highs. It got up a little bit higher before pulling back again. Do you wait until it breaks the low on the daily first and then drill down to the lower time frame? You don't have to. If you want to go for a bigger move, look at your dailies and say, okay, the dailies have a bull flag. Now I'm going to go intraday, and I'm going to find the intraday bull flag, and I'm going to get in on the intraday bull flag and let it go until the daily reaches its profit target. Does that make sense? So you drill down so you have less risk, but you still take out profits based on the daily price move, because a daily price move is going to be bigger than a 30-minute price move. Remember, the smaller the price move, or the smaller time frame, the smaller the price move you're expecting. Do you still take a trade if the retracement is greater than 61.8% of prior swing? No. Normally, you don't want to see it retrace that much. So you're saying, so for example, if you had a big down move and then an up move all the way back up to about here and then a continuation to the downside, maybe, but normally you don't want to see that big of a retracement. You see here, this is about 50%. This is about a 38% or 25% retracement. So normally you don't want to see a retracement that far. If you do get a retracement that far, more often than not, you're probably going to have a bearish divergence, which is a different setup. This is traded a little bit differently, but can still get you in it in the opposite direction. All right, the sell signal on gold was just the NQ momentum green finger around April 8th there. You're talking about, I'm not sure, right here? No, the sell signal was the golf club. And this is just showing that the momentum was weaker and that you had the surge in downside momentum. Because remember, you want to see a follow-through of momentum once that market breaks the previous bar's high. So here you surged up. Over here you surged down again. Over here you surged down, followed through by a lot of downside momentum. All right, more questions. How do you know when the down arrow bar is the entry bar? You know it's the entry bar because it broke the previous bar's high, okay? So, again, you're long on the break of the previous bar's high. So you have a lower high, and then a lower high, and then a lower high. This one right here, this blue, where this blue arrow is pointing, broke the previous bar's high. That's your entry. Just like over here, you have a higher low, a higher low, a higher low, a higher low. This one right here broke the previous bar's low, so it went below the lowest point of the previous bar. That's your entry. The sound is low. I turned it up a little bit. Hopefully this is a little bit better. Is this a good setup for crude oil? Yes, it is. Sorry, there's a whole lot of questions I'm missing. What is the moving average I'm using? That's just an 8 exponential moving average. You don't really have a signal bar until a bar is traded higher than the previous high. By the time you see it, it is already traded higher than the last high. Not sure what you mean. This is a continuation pattern. So you're not trying, for a bull or a bear flag, you're not trying to catch this initial move. You're trying to catch the follow-through. You're trying to catch the continuation in the direction of the initial move. Works well with gold. Gold has a lot of these. The indices have a lot of them. Crude oil has them a lot. Soybeans, another really good market. There's a lot of different markets that do them. did I say I want the bar to close above the higher low of the previous bar? No, you just want the bar to close up or down in the direction of the break. You're getting long as soon as it breaks the previous higher low. Settings on value bars are a 5-bar analysis period. You would only trade in the general direction of the day, or is it counter trend okay too? This is a continuation pattern, so this setup wouldn't happen counter trend. It's impossible. It's in the direction of the trend only. Of the whatever time frame you're trading on. Yep, works well on Russell. Look a little bit different from TOS. Yeah, all the platforms look slightly different than each other. I take it that it doesn't have to be exactly 3 lower highs. If there are 5, you could still take the break. Yeah, it doesn't have to. It could be anywhere from 1 to 4 is typically what I'll look for. Do you wait for the bar to close or enter on the break? You enter on the break. If you wait for the bar to close, then you just missed out on this entire move here. You missed out on that much of that move. Does it only work for day trading? Nope. Works for swing trading as well. On the S&P, you show the prior bar break. On gold, you showed the break of the lowest low in the flag, which is used. I'm not sure what you mean. For gold, gold's a golf club. Remember, the golf club is bearish, so the golf club's a down move. A bull flag is an up move. Okay, so gold, you're going short on the break of the previous bar's low. The S&P, you're going long on the break of the previous bar's high. Yeah, it works in Forex. I'll show you an example here in a little bit of some Forex. Does it work for options trading? Yeah. Ronald, not really sure. Haven't really tested it out with tick charts. The real practice is not easy to identify those flags. That's because it's actually a lot easier than you think. All you're looking for is a big down or up move, and then you're looking for, as soon as you get one higher low, so as soon as you get a bar that has a higher low like this, you're saying, okay, I'm waiting for it to break the previous bar's low. And then it makes another higher low. You go, okay, I'm waiting for it to break this bar's low. It makes another higher low. And you go, okay, I'm waiting for it to break this bar's low. So you just put your entry order just below that previous bar's low. And then as soon as it breaks it, you're in it. So it's pretty simple to do. A lot of times if the market just reverses, you won't get a break of the previous bar's low. It'll just go like this all the way up, and you'll have higher lows all the way back up. 1 to 4 lower highs. When you see a bar or lower high, you say 1875, then you enter an order to buy 1875 quarter. If it's still lower high, the next bar says 1873, you put an order again to buy at 1873 and a quarter. Exactly, Ken. Can you show us a 1-bar move? Yeah. Here's one right here. Here was an up move. Here was a lower high. Here was a break of the high. So lower high, this bar broke the previous bar's high. Didn't follow through as much. But again, you're expecting at least a retest of the highs. So you got that. It actually went a little bit further than that. That's why when it pulls back a little bit further than that, it's a little bit better, because you're still expecting a retest of the highs. How many ticks above or below is the entry? 1 to 2. Not necessarily, Richard. You don't have to be super fast to do this, because you're trading off of a 30-minute price bar. So normally you're going to have 30 minutes go by, and you're going to say, okay, we just put in a lower high, and you check back again, put your order in, and you check back again 30 minutes later. Oh, we put in another lower high, put your order in, check back again 30 minutes later, and you keep doing that until you get a break of the high. What's the significance of the colors in the bars? That's value bars, showing you overvalued and undervalued prices. Can you trade on 10 minutes? Sure. All right, so let's look at a few more chart examples, because we only have about 15 minutes left today. Here's, for those of you that were asking for end of day, here's some end of day examples. All right, so here's a bull flag in gold. Here's your up move. Here's your lower high. Here's the break of the high. Here's the follow through. Here's the up move, lower high, break of the high, follow through. Lower high, break of the high, retest the highs, couldn't continue on, pulled back. So you're over there. Keep in mind, you want to see the surge in momentum. So this first one, you had the surge in momentum. The second ones, you actually had weakening momentum. Here's a nice golf club. Down move, followed by a higher low. So here's your higher low. There's a 1 bar higher low that you were asking to see. Right there. Here's the break of the low. So you broke the previous bar's low. And then the follow through. All the way down. Worked out really well. Gold actually formed another one right here. It came down, put in a higher low, another higher low here, broke the low, and then took off like that. It seems that price likes to return to the 8 EMA, exponential moving average. Yeah, that's why I have it up there. The EMA, that 8 EMA, we call it the gravity line. That's because it pulls prices back to it. The further a price gets away from it, the higher the probability of a market consolidating back to the 8 EMA. Here's another example. This is Apple. This is on a weekly, so this is for those of you that really want to do longer term swing trades. So here was the top in Apple, all the way back here. All right, and then you had this huge down move, and then here's your first higher low. Here's your second higher low. Here's the break of the previous bar's low. Here's the follow through. You're expecting at least a retest of the lows. Well, there you go. You got the retest of the lows. Then you put in 1 higher low, 2 higher lows, 3 higher lows. You broke the low. You closed down, and then you followed through. And then you put in another set of higher lows. Excuse me. Then you broke the low, followed through. Another set of higher lows, broke the low, followed through. Another set of higher lows, broke the low, followed through. Worked out really, really well. Here's another example. Here's an example of a failed break, and this is why you want to see the close up. So here's the up move. Here's a lower high. Here's a lower high. You broke the previous bar's high. You gapped up. You broke the previous bar's high, but it filled the gap and some, and it closed down. Remember, when you break the previous bar's high, it needs to close up, and Apple didn't do that there, and it reversed. So here's another example then. Here's an up move. Here's your lower high. Here's a break of the high with a close up, followed through. Up move, lower high, equally high, lower high, break of the high, followed through, nice up move. Here's another example, lower high, gap up, broke the high but closed down, so you're out, didn't follow through. Does that make sense? Again, it's a pretty simple pattern, pretty simple strategy, but really effective. Here's one for those of you that were asking for Forex. This is the euro dollar on a daily price chart. All right, so here's a bull flag here. Up move, followed by a lower high, break of the high, rally, lower high, break of the high, but you had to close down, so you're out. Then you had another lower high, break of the high, rally, lower high, break of the high, no follow through. This is why you want to watch for the surge in momentum. Over here, another example. Nice up move. Then you put in a lower high, 1 bar that had a lower high, break the previous bar's high, and then you get a rally. Here's a nice golf club. This is just textbook. Big down move, followed by a higher low, break the low, run. And then here's another one. Nice up move, put in a lower high. So this is your first lower high. So see higher high, higher high, higher, 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 higher. Here's your first lower high. Break of the high, followed by an up, close up, market continue to climb the rest of the way, and then again, lower high, break of the high, followed by an up, all the way up. Makes sense? Again, it works really, really well, pretty simple. So those are all the examples. I'm going to answer some questions here, but before I do that, on Tuesday, next Tuesday, we're doing a workshop on trading consistent profitability in smaller accounts for all. And what I mean by smaller accounts, so around less than 500,000. Okay, all the way down. So anything from like 5,000 to 500,000 is what I'm talking about when I say smaller accounts. Talking Tuesday, May 13th. So this coming Tuesday, 7 p.m. Eastern time. We're going to talk about a few different strategies. On how to trade these. We're going to do a lot more on money management, on risk management. It's only $297. if you want to sign up for that, valuecharts.com/growth. I'll be the one hosting it. It's a 3-hour workshop, so it goes from 7 p.m. Eastern Time to 10 p.m., but I stay in it as long as people are asking questions, because I don't want anybody to pay for something and then not get all their questions answered. So if you want to sign up for that, valuecharts.com/growth. It's $297. It's a 3-hour workshop. So it's $100 an hour basically. It should pay for itself 10 times over in trading. And it's May 13th, Tuesday. All right, so let me answer some questions. Look at the daily trend, then you drill down an intraday time frame to look for a bull or a bear flag. Yes, but not necessarily, Toby. If you're trading off of a 30-minute chart, you could just trade the 30-minute intraday trend. It doesn't matter. If you're just going for a day trade, you don't have to trade the swing trade, okay? Because you could have some nice pullbacks that are $400 or $500 contract moves intraday in the opposite direction of the trend with very nice valid setups. You do not use TradeStation, and you trade using candles as opposed to bars, which is a significant colors in bars. Again, that's value bars. What they're showing is moderately overvalued, significantly overvalued, moderately undervalued, significantly undervalued. And then center area, the green area, is fair value. So upper red segments are significantly overvalued. Upper yellow segments are moderately overvalued. The green segments are fair value. The lower yellow segments down here, moderately undervalued. And the lower red segments down here, are significantly undervalued. Keep in mind with value charts, they're not designed for you to just buy or sell because they're red or yellow. You need to take into context the bigger picture. So you're looking at the momentum, the value, and the price action. All right. So when you have all three of those combined to give you a setup, that's when you have the good setups. Valuecharts.com/growth is how you sign up for that workshop on Tuesday. What's the difference between trading the 30-minute and trading a 250 tick chart? Which is better? A 30-minute chart, all right, remember, the shorter the time frame, the smaller the expected move. Okay, so a 30-minute move, you're looking at it coming down and then back up, and at minimum, remember, you're at a minimum expecting it to retest the lows. Well, this distance right here on a 30-minute chart could be $200 to $300 a contract. On a 250 tick chart, this move here, because you're expecting, again, a minimum retest of the lows, this move right there could be a $50 move. Okay? So the longer the time frame, the bigger the expected move. That's why I like trading the longer ones, because you can get much more from it. Does it tend to work out better when the flag forms within the range of the prior range bar? So you're saying, okay, you have, for example, a bearish engulfing pattern. So you've engulfed, you had this huge down move, and then you have the higher lows right here inside the body of this big down move. And then you have the break of the low and the continuation. Yeah. It also works a lot better when your momentum stays green or stays red. So for example here, when you had this bull flag there, see how the momentum stayed green this entire time? It didn't go back to red. That works out a lot better than if it had gone up to green and then back to red and then back to green. Valuecharts.com/growth. There's the link. Is this session for trading stocks only? No, the workshop on the 13th is actually for trading futures. But you can use the same setups that we'll be talking about a lot about futures, because we'll talk about what markets to trade, what markets to avoid. But the setups that we're going to talk about in it, you can use those with options as well, or with equities. Does this work well with crude? Yes, it does. It is May 13th, Tuesday. It's next Tuesday. Trading these types of setups, what is real-world expectation of annual growth of the account? It depends. It depends, because there's so many different factors that go into that. You could say somebody, because there's people that will cut off their winter short. There's some that will let them run longer. There's some that'll go for only swing trades within the day trade, or day trades within the context of a swing trade. So there's so many different variables, it's impossible to say what the expected growth is. But what we're going to talk about in the workshop is earning $500 to $1,000 a day. Do Platinum members have to sign up for it, or do they have access to it by default? No, they have to sign up for it. If you're a Platinum member, you actually get a discount. It's $197 for Platinum members. So if you are a Platinum member of ValueCharts.com, you get $100 off. Send an email into support@valuecharts.com if you're a Platinum member and you want that discount. On the Apple chart you just did from December to January uprun, how many trades from initial entry long, hypothetical, would you have done on that uprun? I don't know. I have to look intraday, Sandy. Is this webinar being recorded? Yes, it is. If you can only trade within the first 2 hours of the trading day, what would you recommend? What do you mean the first 2 hours of the trading day? Are you trading equities? Are you trading futures? Are you trading Forex? Are you talking about the Asia session, the European session, US session? Is there a recording? Yes, there will be a recording. Yeah. Trading room members, platinum members of ValueCharts.com, you get $100 off. Send an email to support@valuecharts.com and Min will help you get that $100 off. To use what is taught in the workshop, will you need to have ValueCharts tools? Yes and no. Some of the setups, about half the setups, are going to use tools that everybody will have, and about half of them will need ValueCharts. Trading these types of setups in the trading room, we did an experiment for a little while. Just in the trading room, we took a $100,000 account. With all the setups we pointed out in the trading room, it was up to $200,000 in a little less than 3 months. What's the best time frame for good profits in commodity market? I like trading commodity futures between 8 a.m. and noon. And then again in the afternoon from about 1:30 till about 3. Yes, it's recorded. Is the May 13 session independent of ValueChart software? A lot of it is. Yes. You don't have to have the indicators to benefit from the workshop. No. Again, a lot of it you do not need to have the indicators. About half the setups we're going to talk about, you don't need the indicators. It appears that this type of bull bear flag setup will work with almost any stock, option, commodity, etc. Yes, that is correct. U.S. session for trading futures and or options. Yeah, you're not going to have these setups. These setups normally happen over the lunch hour because what happens is markets run. Wow, can't draw with the mouse. The markets run up before lunch or run down before lunch. Over lunch, you get some profit taking while traders are out, and then it continues. What's your email? You'd like to know what my availability is for the one-on-one consultation early this week. My email is twood@microquant.com. Feel free to email me directly. It takes me a little bit longer to get back to you because I have a lot more responsibilities. But yeah, my email, if you ever need to contact me directly, is twood@microquant.com. Support at ValueCharts or support at MicroQuant, either one. You like it. Sounds good, Joe. Glad you like it. On Apple trade question, if you enter at the first good entry as it broke above the high of the previous bar, how long would you have stayed long since it kept breaking higher for over a month? This pattern happens on many stocks and futures. That's a very good question. What you can do, let's go back and look at the Apple chart. You stay in until you break the previous bar's low. That'll keep you in it for a little while longer. So, for example, you got long here. You stay in it until you break the previous bar's low. So haven't broken it. This one might have broken it, but you didn't really truly break it until all the way up there. So that means you would have been long from down here and out all the way up there. There's a number of different ways you can stay in trades longer if you're looking for swing trades. Your webinar is wonderful. Thank you for all your sharing. Awesome, my friend. Sounds good, Richard. What other indicator can you use instead of NQ momentum? Use an MACD, MACD. How do you find these setups? I scan through the markets every day, just sitting there looking at them. If you're looking for end-of-day setups, all you got to do is check once at the end of the day, see if there's a setup. If you put in a lower high, you put your order in there for the next day, and then you go to work. Yes, it is, Eddie. This is the workshop I had a questionnaire about last week. Can I teach you how to trade the DAX or Euro Stoxx 50? Sure. I'll show you in the workshop some of the strategies that we're going to talk about work really well in the DAX. Jonathan, it depends on how many setups there are. Yep. Will that be covered in the workshop? A number of ways to stay in the trade longer. Yes. The best time frame for commodities market, again, it's trading between 8 a.m. and 12 p.m. Eastern time, in my opinion. In the May 13th session for futures, you use time tick volume charts. I use time and tick charts. Yeah, candles will work just as well as bar charts. They show the same thing. Jai, I can't, not right now. We don't have time for that because this is only supposed to be an hour long. It seems like there are specific strategies for each type of market. Is that true? Yeah, there are some markets work better with some strategies and some work better with others. That's one of the things we're going to talk about in the trading room. Oh, 30-minute for day trading, 30-minute charts work really well for bull and bear flags. Sorry, I didn't understand the question. Yeah, 30-minute charts work really well for bull and bear flags for day trading. For swing trading, use daily charts or 240-minute charts. Yep, well, I will do that, Rodney. I'll point out different markets that are good to trade for smaller accounts and bad to trade for smaller accounts. If you want to do longer trading, trade with a daily. Yep, a daily or a 240-minute. All right, that's it for today. I hope everyone enjoyed it. Again, if you want to sign up for that workshop on consistent profitability for smaller trading accounts, valuecharts.com/growth. It's only $297. You should pay for that in one trade, in half of a trade. So hopefully you will be able to attend. It's Tuesday, 7 to 9 p.m. or 7 to 10 p.m. I'll be teaching it. There will be a recording, so if you do purchase it and you can't attend, you will get access to the recording of the workshop. I hope everyone had fun. I hope you learned something. Have a great rest of the weekend, and until next time, happy trading. Oh yeah, if you're a platinum member, if you are a valuecharts.com platinum member, send an email into support@valuecharts or support@microquant if you want the discount. All right, have a great weekend.